Tip of the cap to you folks. Thank you for joining us on another episode of the Pilot Money Guys podcast. My name is Ben Dickinson, aka Cowbell. I am subbing in for our great MC, Robert Eklund, aka Rubber Mallet. Flight crew today, joined by, of course, the one and the only man, the myth, the legend, certified financial planner, Charlie Mattingly, aka Godfather. Charlie.
Yes.
How you doing?
Thank you. Nice job, Ben, man. Good intro.
Thank you.
And you're doing a great job of replicating Rubber Mallet there. That's good.
It's hard to do, big shoes to fill, but I'm honored to even get the opportunity. I practiced in the mirror about 10 times before we hopped on. So, but good to be here.
Right on.
We're excited today. We're going to be talking about the situation going on in Ukraine and how that affects our investing in the economy. But first, before we do that, before we jump into that, first of all, our thoughts and prayers go out to everybody in that. It's terrible situation. As everyone knows, I think everyone is pretty much unified on what's going on. But so we definitely, our hearts go out to everybody suffering in that situation. We're actually going to talk probably towards the end, maybe even throw out some places that you can actually donate if you want to get involved. But first, before we jump in, we're going to talk some airline news and just news in general that's going on. So Charlie, we've got some crazy stuff going on right now. Obviously the situation in Russia and Ukraine, we can hardly even get past that, but what do we got for us, Charlie?
Well, first of all, our regards to Rob. We're going to miss him today, but he's got other family obligations, and we've just had some scheduling. I was gone for a while overseas into Africa, and a war broke out, so I had to come home early. No, I didn't come home early. I'm just kidding.
Yeah,
but,
well,
it was crazy.
It was suspicious. You were gone right when there was some news about a ghost of Kiev going around.
I know.
You happened to be gone right when that was going on. It's just,
what a coincidence, right? Yeah. What a coincidence. That's all I can say. I wish I could fly back in a fighter jet. It would like break my neck again. My neck has been broken before, not by an airplane, but it's been broken, and I would never get back in a high G airplane. Otherwise, I would not survive. Just for that reason alone. But it would be cool to get back in an airplane and go do some good somewhere. But anyway, no, I'm glad to be back, and we miss Rob today, but we're going to carry on and provide some good stuff. So one of the things here that's super interesting is what in the world is going on in Russian airline aviation, because Ben, what's happened is the sanctions that have been put on, by the European Union. I'm not sure exactly which entity or which country is responsible, but basically they say something like this: you cannot loan money to Russia anymore. That's, in other words, one of the sanctions. If you're a company in United Kingdom or wherever the sanctions may originate from. So what that means is, and we're using an article from the Air Current, which is a great source, and it creates a really fascinating situation. So think of all these cars out there that are not paid off, and all of a sudden you got to repo all of them. The repo man coming after all these cars. That's what's happening. And so you can imagine what that chaos
a show, Airplane Repo.
Yeah, that's what's going on.
This is the real deal.
Real life. So it says here in the Air Current says one of the leasers is called SMBC. I don't know that acronym or what it stands for. It's basically a bank. I think they're based out of Ireland. SMBC, which has the second largest number of aircraft operating in Russia, has been given until March 28th by the European Union to terminate their leases with Russian airlines under Western sanctions designed to economically cripple key parts of the Russian economy. It's severe punishment for invading Ukraine. So the story goes on to talk about this one Aeroflot, which is the Russian airline that flew into Egypt, I think it was. They flew into Egypt in the middle of the night. They had to fly around Ukraine, which added a couple hours. And evidently Egypt is a really hot spot for Russians to go on vacation because of the warm weather or whatever. Mm-hmm. But they went down there and they somehow landed, offloaded their passengers, and were able to turn around and take off in the middle of the night without being repoed. I don't know what that looks like or how that happens, Ben. But basically they took off. And when you're an airline, you got to have a current air certificate. There's, it's highly regulated, and I don't know who's regulating the Russian airlines per se, but they do have a regulatory authority. But basically they took off with no approval from anyone. They're just trying to get the heck out of there with this airplane, I think is what they're doing. And in fact, the article says we don't even know if they had passengers on board or not. They just, took off to try to get back into Russia. And
oh my God. Yeah.
So the plane is now in Russia. They said back in Russia, and is only flying domestic inside of Russia.
I just can't believe that. I mean, no one's going to go into Russia and just try and grab this plane. But I saw here, and this is from the Federal Air Transport Agency of Russia. It's called Rosaviatsia, I believe.
Nice job.
Yeah, thank you. I've been listening to a lot of news in Russia, so it's getting me. But they said due to a high risk of detention or seizure of Russian airlines, half of their flights are not going to be taken off. It says that domestic flights will continue without restrictions, but they're basically banning most of their international. It says more than half of their international their routes are canceled. Wow.
So here's the article. It says, with the March 2 termination of the lease agreement by SMBC, while en route, Aeroflot, this is what I was referring to, was notified by email and fax that it was obligated to hand the aircraft over to Egyptian authorities. Accordingly, in such circumstances, the aircraft must not fly and should therefore not leave the airport where it is located. That was the message from the Bermuda Civil Aviation Authority. The aircraft would be put in storage and later flown out of the country. Now, why is Bermuda? What does Bermuda have to do with it? But SMBC Global Aviation is based in Ireland, owned by Sumitomo Mitsui Banking Corporation, based in Japan. And while Russia's flag carrier registered the aircraft under a flag of convenience in Bermuda. So do you hang on to all that stuff?
Yeah.
So what a mess it's created is really the point of all that. I just can't even imagine.
This is another article that's talking about the Wall Street Journal article that we had talked about, Charlie, but this one says there actually have been a handful of successful attempts at reclaiming property. One is a Boeing 737-800, and it was seized last weekend in Istanbul. And so I guess they've gotten a couple of them. And then when that started happening, they must've been like, oh yeah, we can't let any of these get out anymore. And,
but I think it really boils down to these companies that leased money or loaned money for these leased airplanes. They're going to lose billions of dollars. They're not getting their airplanes back.
Yeah. One piece of news though, I want to mention, this one's really sad. The world's largest airplane, the Antonov AN-225, has been destroyed during the Russian invasion of Ukraine, according to Ukrainian officials. It was nicknamed the Miraya, or Dream in Ukrainian. I hope that's correct. And it was parked near an airfield in Kyiv when it was attacked by Russian occupants. So they said they're going to rebuild it, but they have destroyed the Miraya. It was built in 1988 by the Antonov company based in Kyiv. And it looks like it says the estimated restoration is going to take over $3 billion.
Yeah, I can't imagine why they would do massive. That.
Yeah, just another casualty of an awful war.
Yep. Yeah, it's terrible. It's awful.
Yeah. Well, jumping into more of the financial topic today, Charlie, we've had some news here recently of some stock splits. They've been pretty big on the stock market front. I know Amazon, Google. I think we've had some others. Well, what do you think about what's going on with these stock splits? Should we buy? Should we buy Google? They're stock splitting. Come on.
Yeah. Well, let's clear the air about stock splits and what it means, first of all. So a stock split, let's just say one share for Google, I'm just going to make up numbers, is $100. When they split the stock, it just means now you own two shares at $50 each. There's actually no change in value whatsoever in the stock or in your investment. No change in the company, no change in the value. It's just they changed the price of the share. That's it. Now, why would a company do that? Well, back in the day, and I'll say back in the day as in maybe 70s and 80s, I don't know when this shift happened, but it used to be that the majority of single stocks were owned by individuals. So you'd open up your Sunday paper, you look at some stocks, and you go buy some. That's it. That's how it happened. So what these companies wanted was for the average American to be able to go out and afford one share of their stock. So right now, there are some companies that still have never split their stock. I think Berkshire Hathaway is one. I think their stock price per share is about $400,000 if I remember correctly.
I think it is. Yeah, I think it's up there.
Yeah. So back in the day, you couldn't go buy, the average person could not buy one share of Berkshire Hathaway. Well, Anymore, that's not as critical because there's so many institutional buyers, and by that I mean mutual funds, insurance companies, and they don't really care the price of the stock. However, what Amazon said was, we want to split our share. We want to make it more affordable for our employees and allow them to buy more. That's probably a cover story, is my guess, because Amazon announced it after Google and maybe one other company.
It's like a pizza, you have it sliced in 8 ways, or you can slice it in 24 slices, but it's not it doesn't change the amount of pizza you got. It just changes the amount of slices. So I know Tesla did it. I think it was last year when Tesla did it. It could have been in 2020, but I believe it was last year. And, it was kind of hot news. It kind of was the social media storm again, took that one over. And, we saw it actually perform well after stock split, but I don't know if people really realize that fundamentally it changes absolutely nothing about the company.
Right.
You're not getting a free share or anything like that. Yeah. Am I right?
Yeah. I think maybe the one thing that is a positive is, for it to split in the first place, the price has had to increase in the past. So maybe it's a testimony of, hey, we've done well, the stock price has gone up, so let's split. However, again, that's something in the past and is not indicative of anything going forward. But I can't remember, Ben, if it was Google or Amazon, one of those two. One of them wanted to be included on the Dow index. And because it's a price-weighted index, they weren't included. And so if they can get included on these indexes, that means they're going to be also included in all the mutual funds, let's say an index mutual funds that mimics the Dow or mimics the S&P. That's maybe one reason they've done it before. We've also seen, Ben, you and I the other day were with a client. He presented a company and said, hey, they did a reverse split. In other words, they wanted their share price to be higher. And we speculated, we didn't know for sure, but maybe that would allow them to be included on the NASDAQ exchange, and they weren't already included there. So those are some other
you're right
reasons.
about that. Yeah, I've seen that same thing. And, just one point on this is that, if you're an investor, and for instance, let's just say you have a 401k and it's invested in a target date fund, you own these companies already that are doing these stock splits, especially if it's Amazon and Google. You're going to own probably even a significant portion. Most of your money may just be in those companies right there. They're the top 5 biggest companies in America or in the world even. So you're going to have a lot of ownership in those. And in fact, we were talking to one of our clients recently, and I want to get into Google. Yeah. And I'm like, well, let me just check really quick. I know you got some Google, but let's see. And I told him, you've got $5,000 worth of Google actually already. Yeah. Oh, really? I didn't even know that. I've got these funds that don't really say the name, but my only point to that is, some people, if you want to get involved in this, you may not even realize that you actually already are in those funds or in those stocks, and you're going to get some of that upside if there is any. So just something to consider.
Exactly. I would say, like, the number of clients that we have, I can't imagine any of them that don't already own those companies. Now, the percentages are going to vary depending on, how heavy they are in stocks versus bonds. But the good news, Ben, is we just learned this the other day. I'm kind of embarrassed to admit that it was Thursday. And I was like, wait a second, something's happened with one of our favorite indexes that we buy, a CHB, which is a broad market Schwab ETF. It actually did a 2-for-1 split along with Schwab Large Cap Growth ETF, Large Cap, there's the broad market, Schwab US Small Cap, and Schwab's REIT, all did a 2-for-1 split. So a lot less exciting though, Ben. That didn't show up in the news.
No, it's not. I mean, I think that's another side of it. That's is, right. Any chance that CNBC can talk about some of these big companies, they know it's going to get the attention. So they know they're going to talk about it. And sure, they know just as much as anybody the stock split actually means nothing for the fundamentals, but hey, it's good news that they can talk about. And so unfortunately, I guess the broad market fund is not as quite as sexy as
it's not as
Amazon
exciting
or Google, but no.
But the companies that do this, Google, Amazon, and like you said, Tesla in the past, they also know that they might get a bump in their share price. However, we all know, and it is true, that is completely psychological. In fact, a lot of folks have said, hey, we want to participate in this. We want to buy more Google shares or Amazon shares because we think the split's going to be great. And I think, again, there could be a price increase based on that news. However, Ben, you and I looked at Google. They announced their stock split on February 1st, and their price increased by 6% that day. So the moment it's announced, the moment that becomes public, the price increase is almost instantaneous. And I don't even think I don't think the split's happening until what, June or something. So
yeah,
it's already
I know the
baked.
Google ones in the summer. Yeah, late June.
Point of that is it's already baked in the price. If I buy it, if I don't own it at that moment that the split is announced, I don't think, Ben, you can profit from it. I don't think you can take advantage of it. It's already over.
Yeah, it would be really, you'd have to really be on it. And then again, not all stock splits, not all of them do increase in price after a stock split. Yeah. I mean, we don't see that every time. And how would we know that that's coming in the first place? But you're right. I don't think there would be a way. We were looking at the charts before this, and it was the same day. I mean, it was funny. You could see on the chart the day. We didn't even have to hardly look it up what day they announced it, because you can just see it on the bumps. And there it is, February 1st, Google announcement.
So whoever's maybe looking on Google or YouTube, the announcement was February 1st. It went from -5, and this is performance year to date, up to about a little over 2. So that's almost 7% if my math is correct.
You're right. Yeah.
So that was the bump, and that was on February 2nd. But since February 2nd, Google has gone from 2% up till, and right now at this, the last day of the market opening, it's down 10-ish, a little over 10%. So that's a 12 percentage point swing downward since the little bump from the announcement.
Yeah. Yeah. And I mean, that pretty much just tells you right there the story, it's just because it even may increase that day, but then you got to sell, you got to sell to capitalize on it. So I think the point is, Charlie, with this is stock split. Should we invest in them? Should we not? Should we try and jump in right when we hear a stock split announced? What is your thought?
I don't know that you can profit from. I hate to be. We're like the party poopers all the time, man. I know. We're just such the Debbie Downers, but I don't think you're going to profit unless you already owned it. I mean, Google, Amazon, maybe they're great stocks, maybe they're appropriate for you to invest in, but I think you nailed it. You already own it. If there's some reason you should buy more of it now, don't do it because of the stock split. There should be another reason. So maybe that's the takeaway.
Yeah, I totally agree.
Yeah.
Well, Charlie, moving kind of closer into the today's topic, how does the situation in Ukraine affect our investing and the economy? I know obviously stock splits are one thing, but the situation is real, and we've got to see it. So I know we talk a little bit about kind of some of the historical perspective. I think it's a good place to start, just looking back, seeing how different wars, different situations, similar maybe has affected the stock market. But what do you have on that?
Yeah, man. So first thing we want to do is we want to talk about a story of a Tennessee boy, because, I think we should get credit because we're in Tennessee too. So we're going to tell a story about what it looks like to have real courage in investing in these difficult times. Now, let me put this in a reference. I think the S&P is down, 12% for the year now, Ben? Any idea?
I think you just had it. It was, it looked like it was down about,
S&P, 11.5, 12%, something like that, depending on the market close exactly. So, but since the invasion, February 24th, I think is the official date, it's down like 0.5%. So let's keep that into perspective when I go through this example from this amazing guy from Tennessee. So Jason Zweig put out a great article, was it this weekend? Actually, Friday, I believe. So he says, in the fall of 93, Adolf Hitler invaded Poland, and a small town Tennessee guy, let's just say Knoxville, small town Knoxville, Tennessee guy instructed his broker to buy $100 worth of every stock trading on the major U.S. stock exchange for less than $1 per share. So his broker was like, dude, are you crazy? And so he went and bought every company that was not bankrupt. And so this guy came back and said, no, every single one of them, I want you to buy every single company and spend $100 on each one. And this guy's name is John Templeton. And he's at a famous, for super nerds that know, in fact, there's a mutual fund company named after him, Ben. I mean, John Templeton's one of the best investors of all time. So at 26 years old, he borrowed $10,000, which would be more than $200,000 today, to finance these decisions. So remember, he did this when Adolf Hitler invaded Poland in 1939. So The interesting thing here is that was 1939. The next year, France fell. In 1941, Pearl Harbor was bombed. In 1942, the Nazis were rolling across Russia. I mean, we were on the verge of the entire world speaking German. So he invested through that, which you think about that, it's like, that's a little bit crazy almost. But he talked about his courage. And in this article, he said, I regarded my own fear. I know Mr. Templeton, John Templeton, he's passed away in 2008, but this was an interview from 1989 by Jason Zweig, and Templeton said, I regarded my own fear as a signal of how dire things were. He said, I wasn't sure they wouldn't get worse, and in fact they did, but I was quite sure we were close to the point of maximum pessimism, and if things got much worse, then civilization itself would not survive. So he didn't think that was going to happen, so he invested. So boy, talk about some guts, Ben. I mean, what the heck?
Yeah. And that's the thing too. I mean, obviously at that point, no one was really thinking this is the time to invest because the news is just terrible. And we've seen this now recently again with COVID and everything like that, when pessimism, we don't know when the upside is coming, I guess we should say. And so when we see that these terrible events are happening, it's sad to say, but and that this headline kind of sums it up. And this is one of our guys, Ben Carlson, we like to read a lot, but it's the stock market is heartless. It doesn't necessarily care about the atrocities that may be going on in the world. Some companies are going to perform well in those environments, and it doesn't necessarily compute with the emotional side.
Yeah, man, I was going to say emotion. You nailed it. I mean, investing is a very emotional thing. And just to finish up this article before you touch on yours, it says Templeton went on to become one of the most successful money managers of all time. The way he positioned his portfolio for a world at war is a reminder that great investors possess 7 cardinal virtues: curiosity, skepticism, discipline, which is what we're big on, Ben, independence, humility, and patience. I love those last two, humility and patience. And he says above all courage, but humility and patience. I mean, we're in this for the long haul, and it takes patience. And we also have to be aware that even though you and I, Ben, especially, and everybody on our team at Leading Edge, we study and look at this stuff all the time, but we have to have the humility to know that we also have to be prepared to be wrong. We want to have the disciplined approach, and we want to have time on our side and patience, and we want to use history as a guide. And in fact, not only know that we could be wrong, but be prepared to be wrong. And Ben, that's why diversification is so important. You have to be You have to be ready and prepared for multiple scenarios all the time.
Right. And we're going through those scenarios in our planning, and we are intentionally preparing for the fact, and we're baking it into the plan. There's going to be downturns, and we don't want you to be in a situation where a bear market comes and you're not prepared. You're not able to have food on the table and be able to retire. And that's what we're trying to prevent for people. And we're trying to plan around that. But the solution isn't necessarily just get out of equities completely.
Right.
And that's another side. There's a fine balance. Unfortunately, we need equities as painful as they can be sometimes. So
absolutely.
This article, the market is heartless. I know this is just a great article. It goes into a lot of the historical dates that are historical events that have happened and what the stock market does. And so as you mentioned with World War II, Hitler invaded Poland on September 1st, 1939, setting off war. When the market opened September 5th, the Dow shot up 10% higher that day.
Yeah.
In 1941, Pearl Harbor, December 1941, stocks opened up the following Monday down 2.9%, but it took just a month to regain those losses. When Allied forces invaded France on D-Day, June 6, 1944, the stock barely noticed, and the Dow rose more than 5% over the ensuing month. Last one, and this is number overload probably, but from the start of World War II in 1939 until it ended in late 1945, the Dow was up a total of 50%, more than 7% a year.
I mean, that chart we're looking at, let me share that just in case somebody's watching on YouTube. Oh, yeah. I'll share that with, and give credit, of course, to Ben Carlson. He puts out tons of great charts, and the people at Red Holtz Wealth Management. But this is from Y Charts, the information anyway. Mm-hmm. So what I love to do, and we did this with our clients, is we said, hey, if you are at or near retirement, the reason you have bonds, and And the bonds are just very difficult to own right now because they've not been doing well. That's more of a story about inflation and interest rates. But they actually do two things, Ben, that we like. They prevent a really steep decline. For example, 2008, I think, and if you look at November 20 of 2007 all the way to the end in March of 2009, the S&P was down, I believe it was close to 50%. Now that was more than a year, but not much more than a year. You know, it was down about 50%. Now, if you owned bonds, you're going to be down a lot less. And so it provides that ballast in the boat, whatever analogy we want to use, but it prevents you from going down so steeply and so much. So the reason that's important, Ben, is because we can recover quicker if we don't go down as much. It's the simple math problem where if I have $1,000 and it goes down 50%, now I have $500, that's a 50% decline, 1,000 to 500. But to get back to 1,000, I need a 100% return to get back to where I was. Does that make sense? And that math is not linear. It's not always that much, but that's a simple example of why bonds are important. If I can reduce the depth of the downturn and I'm near retirement, I want to do that, then I can decrease the time it takes to get my money back to even. So that's one reason we own, actually both reasons we own bond, the time recovery and the depth of the decline. So this chart that we're showing now, 1939 is when the World War II officially started. I think Nazi invaded Poland, like you said. Mm-hmm. And then looks like late 45, it was over. And a cumulative return there was 50%, annualized about 7%, like you said. So, man, it's fascinating to think December 1941, Pearl Harbor, right? And that's when we got dragged into the war, the U.S. anyway. Well, it looks like the bottom of the market was probably late spring, early summer 1942. So less than a year after Pearl Harbor. I mean, can you imagine like, hey, what's the best time to invest? Well, hey, we just got bombed in Pearl Harbor. We should invest. That's crazy. Now that's one lesson, not really the lesson I'm trying to illustrate at this moment, but what I'm trying to show here on this graph and what we talked about with our clients is 1939, 1945 is about 6-year time period. And we want everyone near or at or near retirement to have enough bonds to kind of cover them for these time periods so that if there's any income that they might need, they can take it from a source that's not has not been beat down or steeply declined. You don't want to take your money out of stocks if they're down because you're locking in losses. And early on in retirement, there's a name for this. It's called sequence of return risk. If you start out your retirement with a steep decline in the market and you remove those investments after they're down, you're locking in losses that you may not recover from. So Ben, you and I, we've done this a lot with clients. We model this scenario and go, okay, let's plan for this scenario to happen for everyone, and how are we going to avoid it? So This time it's Russia, Ukraine. Next time it might be something else, 2008, whatever kind of scenario, COVID. But we always have to be prepared for this because we know something is going to happen. Ben, if you could kind of lead us into like, what is the impact, the measuring of global GDP, of mutual funds, whatever, energy. I mean, what's the perspective here?
Yeah, that's a great question. And so when we were kind of doing some research and we're looking into, what's going to really, how much is this stuff going to affect us? And obviously we're not trying to predict anything, but just to, again, get perspective. So we looked up what does an international fund of stocks do, or how much Russian companies are in those. And from what I can tell, the Schwab International Fund, SCHF, it only has about 1.9% of its money or its investments in Russia. So not a large amount. And that goes across the board. I saw some other funds I'd looked up as well that were right in that range, not a huge percentage. And part of that's because Russia hasn't been a very friendly, investable country for very long. I mean, it's since the late 90s, I think they were really trading stocks on a global scale. And so that's kind of a good news. However, obviously, these are international stocks that are invested in other places as well. But what percentage of the global economy is from Russia and Ukraine? So I looked this up. Russia is the 11th largest GDP And this is as of 2020, but 11th largest GDP. Ukraine, 57th largest GDP. And Russia does do a lot of imports and exports across the globe, including to the U.S. So where does it go? I mean, I know we're talking right now a lot about energy prices. So how much oil and natural gas comes from Russia? Well, we looked it up in Europe. About 25% of Europe gets their oil from Russia. They get about 40% of their natural gas from Russia. So that's quite a significant percentage. Mm-hmm. Now, U.S., we get about 7% of our petroleum products from Russia. That includes oil, obviously, and crude oil and gas. But so we may be a little less affected. Europe may be a little bit more affected. So we see that these prices could be going up. We're already seeing that right now, Charlie. So any thoughts on that?
Yeah, it's going to be difficult for Europe because they, like you just said, they were so reliant on the energy. In Germany, I heard in particular, they've also all made a pledge to be off of Russia natural gas and oil by 2030, I believe. But they just can't flip a switch and turn it off. I know there's physical limitations. I don't quite understand all of it. It's very difficult to follow how that all works. But you're right, Europe is going to be much more affected. And again, how does that affect us as investors? Well, should we invest in Europe right now? In other words, should we buy international? I was talking with someone the other day. I said, I think we need to rebalance into international. We don't have enough international. It's like, well, that sounds kind of crazy right now.
Yeah.
But just like the John Templeton article we just read, yeah, we should buy into Europe right now. And in fact, I've got the Schwab international index pulled up, which is kind of representative of, a lot of international indexes. But I also have the S&P pulled up, and they're down exactly the same year to date. I shouldn't say exactly, 11.45% for the international index and 11.55 for the U.S. S&P. So that's kind of interesting. Europe might go into a recession, and we might go into a recession, Ben. So we just have to keep investing with discipline, like we talked about before.
Yeah, and it goes back to diversification. In the future, we don't know what's going to happen, and we know that right now markets are down. We don't know where the returns are going to show up, where it's going to show up first, if it's going to be in the U.S. markets, if it's going to be international. But we still need to stay diversified. We need to rebalance and sell some of these things that maybe are a little bit higher right now and buy and rebalance your portfolios. And so we want to do that, and we want to continue investing.
I think when I first started kind of digging into some things for this podcast and just looking, like you said, what's the overall impact, and even on a video I did before, it's like, hey, look, it's like 1% or less of the global economy. However, there's a lot of other things going on in our economy than just Russia and Ukraine. And again, we're big fans of Ben Carlson and those guys. And I read a piece of his yesterday, and it talked about, are we headed for a recession? I think that's probably going to be the next question on people's minds. And I didn't think, again, the first time I started looking at this, I was like, it's just minimally impact. Unfortunately, it's tragic, but we've kind of have a decent economy going. I say decent because things are never perfect, and we've just come out of COVID, et cetera, et cetera. However, energy prices have gone up. Inflation has gone up significantly, partly because of that. It already was going up. We already had a down market going into this year because some things were overpriced already. Maybe large growth, tech sector is really getting hammered right now. So he made a great point, and it makes a lot of sense. He said, hey, I think we've probably got a 50-50 shot or better of going into a recession. And he's kind of like us. He knows that predictions are really not worth the paper that they're printed on, but it makes sense. And one of the charts he has that I'm sharing with right now, I'm sharing with the YouTube folks right now, is every time since 1940, we've had inflation spikes more than 5%, we've gone into a recession, either during that or following that. Again, you can't predict the future, but the chart's pretty convincing. It's pretty interesting. And I think it kind of makes sense because your economy is getting overheated. There's not enough, there's too much demand for the supply that's out there. That's what inflation is, right, Ben? You're the econ guy. So I said that right. Yeah. So exactly. The Fed has to essentially cool the economy down by taking money out of the economy by raising rates. That's what they're doing. and trying to cool things down so inflation doesn't get out of control. And they're going to do that. Basically, the definition of recession, hopefully I'm not confused too many people, but the most common definition of recession is two quarters in a row of negative GDP. So that could happen. Exactly. It could happen in probably a better chance now than we've had in the past. Like I said, Ben Carlson, somebody that's pretty intelligent, somebody we respect, says 50% or more. So really, again, Ben, the question is, what does that mean for us? Yeah. What does a recession mean to us as investors and our clients and people listening? And I mean, what do you think? What does a recession mean?
Well, I mean, and I was just thinking, and I'll just tell from my perspective and I'm going to say this as an accumulator. And what we mean by that is someone that is continuously investing money into the market so that one day I hopefully can retire down the line. I'm not going to pull my money out within 10, 15, 20 years, even hopefully. And so from that perspective, I think recession, I need to keep investing. This is a good time to invest because markets are going to be down. Is it hard? Of course. Is it scary? Yes. I don't know when, it could, I keep thinking, of course, this could go down way more, but at the same time, we're down, like you said, about 12% on the S&P right now. So on year to date. So I want to invest personally, but at the same time, I want to have my fundamentals taken care of. I want to have the emergency fund ready to go. I want to make sure that I can take care of myself and my family and my health through this, because it's going to be a stressful time. And if I can do that and I feel comfortable, then I'm going to invest. So that's what I'm thinking about for myself and for maybe younger investors or accumulators, people who are investing a lot right now.
Yeah.
It could mean, though, at the same time, it could mean layoffs. What do you got, Charlie?
What you said there, I think resonates, a lot with me. And I say it a lot is a recession is going to happen at some point in the future. It's a natural part of the economy. Economic cycles. But the most important thing, and it is sad, sometimes people lose jobs. It's terrible. 2008, people lost their homes, they lost their jobs, and it's difficult. But the thing that we can do to prepare that is what you just said. You've got to have a strong balance sheet, keep the debt low, especially the unproductive debt, keep it low to zero, hopefully. Keep some emergency savings, keep some cash on hand, and keep saving. Now, not to sound really calloused, but one person said right in the middle of COVID, which is absolutely true, is, hey, if you've got cash and a strong balance sheet, there is no recession. Now, that is very callous because people do lose jobs, bad things happen. But the point is if you have a strong balance sheet, just like a business, and Southwest Airlines is a good example, probably United, I think they did a good job too. Throughout COVID, they expanded their route maps. They said, hey, this is the time where we're going to go in and try to expand our share of the market. And we're going to go in and do that at a lower cost. So again, that's kind of the way we hope we can be prepared to do those things. But as individuals, we have to have low debt. We have to have some cash. If you've got a bunch of debt, you're living beyond your means, you're in trouble when things come like that. And that's the tough part. We can do something about it, I think, is the most important lesson. We have some control over that.
Yep, that's right. We saw a lot of those, like you said, over leveraged companies that get the hardest hit during a recession. They're going to be the ones that end up going bankrupt and having those issues.
The last thing, Ben, is what you mentioned earlier, and that is how can we help other than strap on an F-16 or whatever and go over there. We can't do that obviously anymore, Ben. We talked about we're too old to do that, but maybe we can help with our money. So if you want to do that, there's a lot of great things on the web. You could just Google, best charities to donate to. I think that's what I Googled here and it's on the screen, and there's tons of them. There's going to be, 20, 30, 40 or more, depending on what you want to support. I think the most important things, though, are how to make sure that your money is going to work in the best way. So there's a couple slides here for people that are watching, but it's basically, it says avoiding any scams. Unfortunately, the more need there is in the world, the more scams there will be. Yep. It's just terrible. It's evil, but that's the truth. So it says stay away from individual appeals. Stick with established organizations and beware of newly created charities. Those are just 3 tips. There are 3 organizations that can help you check in on any charity that you might want to donate to. One of them is give.org. The other is Charity Navigator, and the other is Charity Watch. Those are three, I think, that that can help you avoid being scammed if you want to give money. On our screen, there's, gosh, what is this? A couple dozen already that you can give that they recommend. One of them is Operation USA, Mercy Corps, AmeriCares, Matthew 25 Ministries, MedShare, International Relief Teams, World Health, Project Hope, American Jewish Joint Distribution Committee. And again, it goes on. UNICEF USA, Save the Children. There's a bunch of them. So I left a bunch off just because I don't want to read everybody, but there's tons of them. So there's things you can do that may help, and hopefully you can do it safely.
Yeah. And if you're like Charlie and you have you still got your flight suit and your helmet, go to Africa, as they say. Go to
That's right. Quote unquote.
Yeah. Well, thanks so much, Charlie. This has been a great episode. Thank you so much for flying with us today. Another episode of Pilot Money Guys podcast. I'm going to leave you with a couple quotes. As in the name of Rob, I've got Rubber Mallet.
Honoring Robert Mallet. Yep.
Yes. I'm going to leave with a couple quotes. So this first one: success is not final. Failure is not fatal. It is the courage to continue that counts.
That's I love
Winston
it.
Churchill.
Nice.
Last one here. We have always held to the hope, the belief, the conviction that there is a better life, a better world beyond the horizon. And that was FDR. So
nice.
Thank you so much for tuning in today to Flight 28. This wraps up our podcast here. Please reach out if you need anything, and so long.
See you next time.